Settle down, we are about to start in 2 minutes, please. Please settle down, all of you. We are about to start in 2 minutes. Please be seated. Please be seated, all of you, so that we can start in about a minute. Thank you. Assalamu alaikum and good evening. I'm Saddam Hussain, a research economist at PIDE. I'll be your host for today. I, on behalf of World Bank and Pakistan Institute of Development Economics, welcome you all to the joint launch of Pakistan Development Update, Spring 2023. As you might be aware, it's a biannual report by the World Bank summarizing country's economic picture. The latest edition comprises recent economic developments, medium-term macroeconomic outlook, as well as risks and priorities for a way forward. The report comes at a critical time where every Pakistani is concerned and would want to know about the unfolding economic situation. Now, without any further ado, let me run you through to today's program. Besides the keynote address, the program is divided into two sessions. In the first session, we have two presentations by the World Bank. Afterwards, there will be a 10 minutes of question and answer session, and I would request you all to be very brief when you ask question and use the Slido app, which is showing on the screen. They will show you now. So we will not be entertaining question in person. You can just click on the link and just type your question very briefly. So we will display your question on the screen and we will respond from here. In the second session, we have a panel discussion on the same report focused on the similar macroeconomic issues as outlined in Pakistan Development Update. And towards the end, the program will conclude with Aftar. Now to commence today's proceedings, I will now invite Naji bin Haseen, a great friend of PIDE and World Bank Country Director for Pakistan. Please.
Bismillahirrahmanirrahim. Assalamu alaikum. Hello, everyone. We have full room, very impressive. There's three hypotheses. One, it's the iftar that attracted so many of you. Second, we are co-organizing with PIDE, and their reputation attracts a lot of people. Or maybe it's the state of the economy and the content of the report. So I hope it's number three. So thank you very much for the launch of the spring edition. We launched the Pakistan Development Update twice a year, right before the spring meetings of the World Bank and IMF, which are happening next week, and the annual meetings. It comes, and I would like to extend first my gratitude to the speakers who have graciously agreed to be part of today's launch. Dr. Dur Nayab, I can see her. Oh, here, good to see you. Good to see you. And a friend who's director of research and joint director of PIDE, the Pakistan Institute of Development Economics, with whom we have a partnership. Dr. Farouk Pasha, who's an economist at Standard Chartered Bank, and Hadi Khizar Aslan, head of research at Business Recorder, with whom I was in a panel with him not long ago. Thank you for making the time. So very excellent panel and very prestigious panel. And thank you to PIDE and the whole team for organizing this. So this report comes obviously at a critical time, a critical stage of the Pakistani economy. The macroeconomic risks, as you know, are very high. Domestic inflation is high. The reserves are precariously low levels, and the global environment is constraining. Global liquidity conditions are tight. Interest rates are rising. Private sector activity has suffered badly, of course, from the floods, from the external shocks, but also from the controls and the administrative import controls that have been put in place. the high input and borrowing costs, and the policy uncertainty above all, as well as the global slowdown in demand from abroad, but also from domestic demand given the crisis. As you'll see, we estimate growth to be at 0.4% in real term this year. And the team will go into more specifics. And the external liquidity conditions continue to deteriorate. The urgency of securing new external financing, as you know, as well as continuing to implement reform and maintaining prudent macro policy, especially on the fiscal side, but also on the exchange rate management, monetary policy, and trade policy, is becoming increasingly important to restore confidence, to restore investment, and to prepare the foundations for recovery. And this report was not easy to write. I mean, the team has done excellent analysis, and we'll have an exchange with the room to see if you agree with this. But it's very hard to have distance from the immediacy of the risks that are facing the economy and speak about the fundamentals and finding the right balance between presenting the evolution over the past months of the economy, the challenges ahead, the outlook over the coming months and year or 2 years, when the situation is so uncertain and volatile. But at the same time, the reasons that led, as all of you know, the reasons that led to such difficulties and imbalances and critical imbalances today in the Pakistani economy are known, have been there for a long time and remain as urgent as ever. And as you'll see from the title of the press release that I think has been launched to the press as I'm speaking now, commitment, political commitment and consistency over time of the reforms, be it in the fiscal side, be it in the power sector reforms, be it in the investment climate reforms, trade reforms, is what will be critical not only to restore stability, but most importantly to restore confidence and to hope that this will lead to a return of private investment, including foreign investment flows, and a recovery that is sustained over time. So difficult times, but right times to have a good discussion right before iftar. So I'll end here and thank you. Congratulations to the team for the launch. They did amazing work. So thank you, Adnan, Derek, Gonzalo, and Tobias. I'm sure I'm forgetting many. Congratulations to the whole team. Thank you very much for being here.
Thank you, Naji, for taking care of the difficult part, opening this session. And now to discuss the key messages of the report and present World Bank's medium-term economic outlook, we have two presentations by the senior economists at the World Bank. The first presentation is by Adnan Ashraf Ghumman, followed by the second presentation by Derek Chen. So I'll invite on stage Mr. Adnan Ashraf Ghumman to present. Thank you.
Can I get the mic and click? Mic. Oh, clicker bhi de do. Assalamu alaikum and good evening, and it's a pleasure to be here today, and I welcome you all on behalf of the World Bank. My name is Adnan. I'm a senior country economist with the World Bank, and I'm one of the lead authors of this report. So basically, Pakistan Development Update is a biannual economic update of the World Bank. And this edition of the development update, it focuses on the first half of the fiscal year 2023, but there are some exceptions where we have high frequency data. The presentation today will primarily cover the key messages of the development update. So the key messages that we have from the development update this time around is that we are at a time in Pakistan where growth is slowing down and inflation is picking up. While Pakistan is facing external and fiscal sustainability challenges, but at the same time, we have an economic outlook which is highly uncertain but contingent upon government's ambition and basically speed with which it can implement critical macroeconomic reforms. So essentially because we are focusing on the first half of the fiscal year, and Pakistan does not publish quarterly national accounts, we are looking at the lead indicators for the real economy to estimate what has happened to the growth in the first half of the fiscal year. And for this, we are looking at the critical data for the three sectors of the economy: agriculture, industry, and services. For agriculture, the assessment is that the recent floods and the difficulty in obtaining inputs such as fertilizer and animal feed is impacting the agriculture output. At the same time, for the industrial sector, we have the monthly large-scale manufacturing index, and that basically has shown a half-year decline for the first half of 3.7%. Now, interestingly, this is the first half-yearly decline since the second half of 2020. Now, if you recall, 2020 was a year when the pandemic was around and globally economies were struggling because of the lockdowns. And this year, Pakistan has also, interestingly, suffered a setback due to the import restrictions, but at the same time, the industrial sector has been impacted by the fact that there is policy tightening. Now, at the same, in parallel, the services sector of the economy, which is around 60% of the output, is basically also impacted by the rising costs, particularly the credit costs, and at the same time, it is impacted by the declining investor confidence and consumer confidence. Now, at the same time, we are at a point where inflation is picking up in Pakistan and it's surging. For the first half, we have multi-decade high inflation in Pakistan. I hope I'm audible. Sorry, my apologies. So let me switch to this one. So inflation in Pakistan for the first half jumped to 25%, and this is a multi-decade high for Pakistan. And we have data now for the first 9 months, and inflation has been slightly above 27% for the first 9 months of the fiscal year. Now, if we look at the drivers of this inflation, primarily the inflation has been driven by the global commodity shock, but at the same time the currency depreciation. But we also have supply disruptions due to the flood and the unrolling of the unsustainable fuel and energy subsidies that the government did. Now, if we look at the rural and urban divide of this inflation, rural inflation has been slightly higher. But if we look at the drivers of this inflation, it has been on both sides driven largely by food and energy items. Now, this is important because this can have potential impact on the general poverty level in Pakistan. In parallel, what on the policy side has happened is that the State Bank of Pakistan between July and today has raised interest rates by 725 basis points. But still, the real interest rates remain in negative territory as average inflation is higher than the inflation. Average interest rates are higher than the inflation. Sorry. Excuse me. If we move to the external sector of Pakistan, that is presenting an interesting story for the first half of fiscal year 23. While there was a narrowing of the current account deficit, generally the external sector situation deteriorated because of decline in international reserves. So Pakistan's current account deficit in the first half declined by 60% compared to the first half of 2022. This happened primarily because of the contraction in the trade deficit, which was largely due to the import restrictions, and import approximately declined by 32% in the first half of the fiscal year. In parallel, exports also declined by 6.7%, but the net impact was positive on trade account. While in the first half, we also saw this interesting development of informal cap on the exchange rate, which resulted in a substantial spread between the interbank and the open market rates. What it did was that it created an incentive for the expat Pakistanis to remit money through informal channels. And as you know, worker remittances are a big source of financing the trade deficit, and worker remittances declined by around 10% in the first half of the fiscal year. This trend has continued in the second half, but the cap has been removed in January. Also, in parallel, an interesting activity that happened was that there seems to be evidence from the data that the profits that are remitted by the multinational companies and foreign investors in Pakistan has declined by 80% this year. Now, part of it can be attributed to the declining economic activity in Pakistan, but part of it is also attributable to the capital dollar outflow control that has been put in place. And this is a worrying sign because it is impacting investor confidence, and that investor confidence has basically spilled into the fact that private financial flows in Pakistan declined for the first half. And that basically culminated into a negative overall financial account for the first half, coupled with the fact that Pakistan could not receive official flows because of the delay in the IMF program, and there were higher than usual amortizations for the official debt as well. So this basically resulted in the decline in a decline in the international reserves of Pakistan. Pakistan's international reserves declined to 5.4 billion as of March, which are little less than 1 month of import coverage. Because of this sustained decline in reserves, currency also came under pressure, and the exchange rate depreciated by almost 27% between July and March. Now, if we move to the fiscal sector, what has happened is that there has been some effort by the government of Pakistan to do fiscal consolidation. And it is mainly visible by the fact that energy and fuel subsidies were rolled back in the first half. And that led to a 1.7% contraction in the non-interest expenditures. But at the same time, and this helped in build up of a sizable fiscal primary surplus. But what happened in parallel was that the debt servicing increased by 77%. Now, this is happening primarily because A, the debt servicing cost is going up because due to the rising interest rates. But at the same time, Pakistan is not receiving external financing. Actually, Pakistan received negative net financing in the first half of the fiscal year. And that shifted the burden to the domestic sources because there is a sizable deficit. So in all, what it has done is that it has put burden on fiscal deficit, but at the same time, it has driven up the domestic debt. Domestic debt has grown in the first half, but in parallel, external debt has also increased, not because there have been a lot of new borrowings, but because of the fact that exchange rate has depreciated by 27% in the first half. Now, if we look at this picture combined, what is happening is that there is a lot of stress on the banking sector. All of this financing is met by the commercial banking in Pakistan. If we look at two data points in Pakistan, for instance, we look at 2008 and we look at 2022, the credit to public sector has increased from 30% to 70% as a share of total credit. And if we look at Pakistan and we compare it with the global economies, Pakistan stands out in two respects. One aspect is that Pakistan's financial sector is heavily exposed to the sovereign, to the government. And at the same time, banks' core capital as a percentage of their assets is low compared to the rest of the economies. And the Pakistan is the yellow dot in the right-hand graph. Now, if we look at the economic outlook in this backdrop, in these recent reforms backdrop, it is quite difficult, and the economic outlook is quite uncertain, and it's contingent upon the fact that the government has to implement critical reforms. The fact that public debt is rising in Pakistan and there are liquidity pressures, that creates a lot of downside risks. And the way around this is that government should clearly stay in the IMF program and implement the core macro fiscal reforms, at the same time the structural reforms. These macro fiscal reforms are basically staying committed to a market-based exchange rate, at the same time doing revenue mobilization and also expenditure rationalization, particularly non-interest current expenditure rationalization. But at the same time, it's important that there is a progress on structural reforms in Pakistan. Now, this has to happen in parallel with the fact that government needs to basically get the external financing for the rollovers, for the maturing debt, but at the same time get fresh financing as well, which is committed under the IMF program. Now, if this is to happen, there needs to be two things that need to happen in parallel for the sustainability of these reforms. A, there has to be broad political consensus in Pakistan, which goes beyond the current political cycle. The second thing is that there needs to be a credible and effective implementation of these reforms. Now, if all of this does play out, the medium-term outlook between fiscal year 23 and 25 is, for Pakistan, is of a low to moderate growth with relatively higher inflation compared to past. At the same time, the current account and fiscal deficits either stay constant or narrow a little bit. So what happens to the growth in this year is that economic growth is projected to normalize to 0.4%, based on the fact that agriculture sector is expected to contract due to the flood impacts. At the same time, industrial sector is also taking the hit of import controls and the fact that the economy is slowing down. While services sector growth is expected to slow down, but it is still projected to remain positive. In fiscal year 24 and 25, growth is expected to pick up to 2 and 3%, but still stay well below the potential growth. On the current account side, on the inflation side, inflation because of the rising global commodity prices and exogenous shocks and the fact that currency has depreciated so much and some of the subsidies have been rolled back, inflation is projected to stay slightly below 30%, to be exact at 29.5%. Over the course of next 2 years, the prices are expected to come down provided the fact that the external pressure eases down and the reforms stay on course. On the external account side, we expect to see current account narrowing down to 2% of GDP this year because of the fact that there are strong import restrictions and the fact that the economy has slowed down. But going forward, as import restrictions are removed and economy comes back to a normal behavior, the imports will pick up and the current account is expected to widen to 2.2%. Now, coming to the fiscal deficit side, the fiscal deficit is predicated to narrow to 6.7% this year, and then in the fiscal year 25, it's projected to go down to 6.1%. This projection is largely based on the fact that Pakistan will undertake reforms such as GST harmonization, but at the same time, there will be effort such as property taxation streamlining at the subnational level as well. So the combined effect on the revenue side is there, but at the same time, there is effort on the expenditure side, based on the fact that the debt servicing will remain sizable in the foreseeable future. While the public debt to GDP ratio is only projected to decline marginally, but it is expected that the liquidity pressures that Pakistan is facing today will subside with this reform agenda implemented. Going forward, it is very important that Pakistan continues to implement reforms that can unlock Pakistan's long-term growth potential. And these reforms basically have two elements. One of the elements is the fact that Pakistan has to take fiscal reforms, and in parallel, Pakistan has to take productivity enhancing reforms. The fiscal reforms, which essentially my colleague Derek will talk more about in a bit, are anchored around two things. First, fiscal consolidation, which need to happen through the revenue mobilization and cutting down on the expenditures which are wasteful, but at the same time increasing the efficiency of the expenditures. But in parallel, government needs to redirect these savings towards areas which have critical need for social and physical infrastructure investments. And this has to be prioritized. And one of the value functions that can be used are the economic returns and the social returns. In parallel, it's important that Pakistan eliminates distortions which are curtailing Pakistan's productivity. And these distortions are basically emanating from three areas. One is the tax policy and the trade policy. The other one are the subsidies that government of Pakistan provides to industries. And third is the investment laws that are particularly hurting the foreign direct investment. So in the first case, Pakistan needs to get rid of the tax distortions and the trade policy distortions, which incentivize investors to invest in inward-looking industries, and at the same time incentivizes them to sell domestically rather than in international markets. But in parallel, it's equally important that the subsidies that Pakistan hands out to industry and private sector are looked into, because right now these are basically not promoting innovation and diversification in Pakistan. And lastly, it's important that the investment laws need to be looked at from the perspective of foreign investors, because they face substantial challenges coming into Pakistan. With this, I will stop and thank you, and I remain available for a question-answer session towards the end of the presentation. Thank you so much.
Hello, can you hear me? Good evening, ladies and gentlemen. So what I'm going to present about today is unfortunately not in the PDU report, but it's a sort of a trailer to a new report that we're putting out, and it's focused on reducing Pakistan's fiscal deficits. Okay, so what we have on the left-hand side is the general budget balance as a share of GDP. And what we can see that in fiscal year 2022, Pakistan's fiscal deficit was at 7.9% as a share of GDP. This is actually the largest fiscal deficit in 22 years. not only has it been large, but it's also very persistent. As an average over the past decade or so, it averaged at 6.2% of GDP. And if you look at the average pre-2010 and post-2010, you will find that the deficit after 2010 was 50% larger than that of pre-2010. So Pakistan's deficits are large, persistent, and growing. This persistent deficit has actually accumulated into a large stock of debt. If you look on the right-hand side panel, you see that FY22, debt as a share of GDP was at 78% of GDP. And this is only a tad lower than the all-time high of 81.1% of GDP in fiscal year 2020. These large debt and deficits actually have adverse economic effects. On the right-hand side, you will see that deficits, the fiscal deficit and the current account tend to move together. And when you think back, a strong expansionary fiscal policy tends to lead to strong economic growth. You import more and it exceeds your exports, you have a large trade deficit and therefore a large current account deficit. At the same time, to finance the large deficits, the government has been borrowing from the domestic private sector. And you saw in Nan's presentation that credit to the government as a share of total credit in the banking sector is around 70%. And it has been growing over time. This means that the amount of liquidity financing available to the private sector is actually shrinking. And this has resulted in private investment as a share of GDP being low, much lower or relatively lower than our peer countries. So in view of these adverse effects of a large deficit and debt, the study that we're putting together actually focuses on a few channels to reduce the fiscal deficit. Most obviously, we try to look at federal expenditures and to see how to reduce them, how to increase revenues, tax collections, as well as minimize macroeconomic volatility. Now, let's look at the characteristic of Pakistan's federal fiscal expenditures. On the right, you have a share of GDP, federal government spending, and it's divided into two sections. The dark green portion is what we call rigid expenditures, and the light green portion, which is non-rigid. What's in the dark green portion? You have interest payments, you have subsidies, you have staff payments to staff, pensions, as well as cost of running the civil government. Those are rigid, right? In a sense, it's not that easy to reduce at any one time. The portion that is non-rigid is your development spending, which is more or less discretionary. The takeaway from this is with 70% of expenditures being rigid, it's not easy to decrease your expenditures barring a deep fiscal reform. If you look on this side, you see that interest payments actually takes up to 4.7% of GDP in FY22, right? And then you have your subsidies and your salaries. They add up together as well as about 5% of GDP. So my next few slides will focus on a little bit on each of these to see how we can reduce expenditures. Now, on the right-hand side, we have what we're plotting is looking at subsidies, but in particular, electricity tariff differential subsidies. We see this plots the benefits that each type of household is getting from certain subsidy programs. So we have the poorest households on the left-hand side, and it goes to the rich, right? This is the income distribution. What do we take of it? If we look at electricity subsidies in 2019, look at the light green bar. We see that the poorest households, this bar add up together, they only benefited from like 23% of the energy, the subsidy spending. Whereas the richer households, they benefited like 77%. There has been reform in electricity tariffs since then. So at the end of December, calendar year December 2022, the tariff structure has changed. If you look at the red bar, the lowest households add up together, they get about 64% of the benefits, and the richer households get the rest. So there's a lot of improvement in terms of targeting. You do want to help the poor. And second thing, in terms of progressivity. However, if you look at, let's say, social protection program like this, unconditional cash transfer, and you look at the benefit, look at this bar and this bar, you will see that for BIS, 81% of the benefits accrue to the poorest households, and 19% to the rest. So the takeaway from this is, yes, energy reforms or energy tariff reforms, they are important. They are improving the targeting to the poor. However, there's still more to go. Social protection programs, in general, they are much better at targeting, right? So for the same amount of money the government spends on subsidies, they can take that same amount, put it into social protection programs, and get more benefits to the poor, right? So that's the logic in terms of that. A second category of expenses that we look at is actually operation costs. Now, in 2010, there was the 18th Amendment, where 17 subject areas were actually devolved to the provinces. And the idea was that the provinces would be delivering a lot of things, for example, like culture, education, health, and sports, just to name a few. Then the government, the federal government, they had devolved those ministries, but then over time, those ministries have come back in one way or another. Now, if you look at expenditures in FY19, so this bar, they divide it by devolve, defense, and non-devolve. And what you take away is that in FY19, about 0.4% of GDP was being spent by these devolved ministries. And in FY22, this number has actually grown as a share of GDP to 0.6, right, percent of GDP. So and when you talk in rupee terms, the amount is large. It's like $328 billion that's being spent. So this is another area where we think there are potential fiscal savings. Next slide, key point is that in terms of revenue collection, Pakistan's revenue collection is relatively low and it's pretty stagnant. If you check from 2010 to 2022, it's 12.7 to 12.1, so it hasn't improved much at all. Actually, it's gone down. And when you compare across the region, we know that revenue collection in Pakistan is relatively low. What can we do about it? So on the left-hand side, we take a look at the sales tax that Pakistan has, and the federal government looks after the goods part of the GST. And we see that, for example, so what is characteristic about the sales tax in Pakistan is that it has a lot of exemptions, there's a lot of zero rating, and there's a lot of concessions, right? Most goods are supposed to be taxed at 17, it was 17, now it's 18%, but when you take a look at your receipts, you see that's not the case, right? When you buy, many things are a lower tax rate from that. So what happens? We did a calculation. For example, if you remove all the exemptions, all the zero concessions, and all the zero ratings, what happens to your tax potential? It goes up from like 3.3 to nearly 4. And if you reduce the threshold, right now there's like firms with 5 million per year turnover. If you're below that, you don't file anything. If you make everyone file, then that potential can jump up to 6.5%. So this is a calculation we can do, and it shows some improvement, a way to increase GST tax collection. Another one we look at is the tobacco excise. And what we show here is that right now, tobacco tax in Pakistan, there are two tiers. There's a cheaper tier where you pay like 5.05 rupees per stick. And there's a more expensive brand, a more expensive premium brand where you pay 16.05 rupees per cigarette. And these are the new tariff rates. Now, if you were to collapse them into one and tax everyone at the higher rate, your tax potential, collection potential can jump from 0.7 to 1.1. So that's another thing that's coming out in the report. Now, my second last slide. This chart actually plots the changes into the debt stock, and it shows the different drivers for it. So, of course, one thing that we think of is the primary deficit, which is the dark green bar down here. If you add up all of these over the past 10 years, you'll find that fiscal deficit contributed like 18.5 percentage points to increase in the debt stock, right? But another thing that we see is that, for example, exchange rates or depreciation, when you add this up together, it comes out to be 22.5% percentage points GDP. So the takeaway is that over the past 10 years, things like the macro volatility actually made the debt situation worse. And to some extent, this is done by how the borrowing choices that are done by how Pakistan borrows, whether external, long-term, short-term, all this will influence it. But there's also give grounds for keep your macro stable, and that would help in terms of non-budgetary drivers of debt. Okay, with that, yes, this is the report that we're going to put out soon, so thank you.
वो भाई
Thank you, Guman and Chen, for the insightful presentations. And they say there is light at the end of the tunnel. I say there's iftar preparations at the end of the hall. So we are moving closer. Now for the panel discussion on the same report, I'll hand over the floor to Arup Farooq. She'll be moderating this session. She is an economist at the World Bank. Please, Arup.
Am I audible? Thank you. I think this. Thank you. So continuing our discussion today on the recent macroeconomic developments in Pakistan and the crisis that we're facing and what the path to recovery may look like, this panel discussion is also structured around some of the policies and the reforms that are needed for the economy to recover and stabilize. I'm pleased to introduce the esteemed panel of experts that will be joining us on this conversation. As I introduce them, I'd request each of them to please join me on stage. Our first panelist is Mr. Ali Khizr Aslam. He is the head of research at Business Recorder, and of course, someone whose work and analysis we regularly read. Yes, please. He is indeed a leading and recognized columnist in Pakistan with 17 years of experience in economic analysis and research, and are working in both financial sector and the development sector. Thank you, Ali, for joining us. Next, we have Dr. Dure Nayab. She is the Director of Research. Director of Research and Joint Director at Pakistan Institute of Development Economics. With a PhD in demography, she has done an extensive amount of research on economic demography and age structure in Pakistan and its implications for the demographic dividend, urbanization, and class structure. Thank you, Dr. Dure Nayab, for joining us. And last but not least, Dr. Farooq Pasha. He is currently an economist with the Standard Chartered Bank, working on the Middle East, North Africa, and Pakistan region. He also has more than 10 years of research and policy design experience at the State Bank of Pakistan and has published several research papers on diverse economic issues. So welcome, Dr. Pasha. To begin the conversation, Ali, if I may turn to you. So as things currently stand and what we've discussed since the start of this session as well, the path to sustainable recovery for Pakistan is quite narrow at the moment, the way things are looking right now. So how do you think can Pakistan navigate this narrow path to go from the ongoing crisis to recovery?
Thank you, Arup. It's a very, very, very pertinent question, and it's a very difficult question to answer at the same time. As in the last presentation, we can see that the fiscal deficit is the root of the cause, and there's been a persistently high deficit in the past 4 years with a 7.9% deficit, which is highest in the 20-odd years and all that. And with this and the debt level rising and the external repayment capacity being narrowed, so there is a very difficult path to move on. And we need to understand that this is coming in the backdrop of perhaps the all-time high inflation in the recorded history of the Pakistan. Maybe in some years of 70s, there might be some blip in the inflation, but this is really concerning. And you can see it how it's impacting different kind of household. There's a stampede and in various ration distribution, and then the middle class, they're moving from they're downgrading their lifestyle, moving from cars to bikes, and you see there's a degradation of the lifestyle and the consumption pattern across the board. And the people are not having the proper food and everything and all that. So this is a concern we have to have in mind. And then we need to see how we move towards the fiscal sustainability metrics. Of course, we need to reduce the fiscal deficit. There are no two ways about it, and absolutely. Now we need to look into that, how we need to address that. So as you see, there are two ways to this is to either you declare you work on the expenditure or you work on the revenue, or a combination of both. In terms of expenditure, we see this because there's a high expenditure even on the devolved subject. As someone very beautifully portrayed that even of the devolved subject, the expenditure in terms of GDP is increasing, and in terms of the absolute term, it's increasing manifolds. And then you see this the government expenditure on various of its functioning, it's increasing, and even in these what we don't see is how the spending is going on the provinces side. I mean, after this devolved subject being the money is being more rolled out to the provinces, they have increased their spending significantly, and in terms of their employment, and in terms of people coming in, and the multiplicity of functions are there. So what we need to decide on, that's one, we have like 220 million people, where large number of people are poor, and more people are falling into the poverty line, below the poverty line, and the middle class is shrinking. And because of this high persistent fiscal deficit and the debt issue, that inflation is keep on filling in because of the currency depreciation and all that, these are all the outcomes of those fiscal issues. So either we keep on passing this to the large part of the population, or we work on reducing on the expenditure of the few where the government has committed to take care of it. Now, so we need to see the efficiencies of those people, efficiencies of the employees there in the government, and how this number has increased, and what role they are playing. So we need to introspect, we need to work on that, we need to create that kind of a narrative within the policy making, within the public domain, that, okay, running this high government functionaries and running those PSCs and all that, where the spendings are very high, and the efficiency outcome is low, while the burden of that is passing on to the large population. So we need to create that balance. A. Number two, then in terms of the taxation, where we need to work on the taxation, how we move on. So we see that over the period of time, the taxation is skewed towards the fewer sectors, the manufacturing, and within those manufacturing concern, those who are more into the formal taxation, their taxation has increased, and we've seen they've been imposed on the super tax and whatnot, and the taxes are being increased on that. And then the other is the indirect taxes. The GST has increased. It used to be 15% a decade ago or something, now it's 18%. And 15% was already high, and now we are sitting at the 18%. It's exceptionally high GST. But we have to work, because we do not work on taxing where the people income are, and those who are not paying tax is doing the problem. So if we see the economy in the past 20 years, the sector which grew, and where the wealth accumulation took place, where the new middle class and the new rich class has emerged, and where the consumption that is coming in, which is translating into your current account deficit as well, because those are consuming, and where consumption is largely dependent on the import. So we need to tax that. So that's real estate, land, that's retail, trade, and within the formal sector, those who are not paying the taxes or who are evading the taxes. So we need to crack down on those. Once we crack down on those people who have emerged above the income class and they're consuming more, so they'll be taxed, their consumption would fall down, that would have an impact on the current account. And when you tax more, that'll solve the fiscal problem. And that'll be able to lessen the tax on the formal sector, with the manufacturing sector, where the competitiveness we are losing on that. And when you see that in the SME segment in the past 15 years or so, anybody who's invested in the SME sector, that's primarily into the retail trade or some kind of an import and some kind of a shop they're opening, or they're moving into the real estate. Now, that needs to move to the productive sectors. That needs to move to the exporting sector. That needs to move towards the efficiency-seeking sectors. That can happen once you solve those taxation measures. So that's very important, how we choose that narrow path to move on. Otherwise, the way we are moving for the past few quarters, and we've seen that we're imposing higher tax on those who are already paying tax. We're imposing higher GST. We're letting the currency to depreciate, and the ability of those to pay is shrinking. If you see the March numbers of the taxation, there's been decline because, and the other factor is that taxation is highly dependent on import components. And since we have compressed the imports, because of that, our taxation collection has decreased as well. So that's a vicious cycle because your taxation is decreased, and for the other factors, because your inflation is going, you have to raise the interest rate. That's causing another problem. So forget about the primary surplus or primary deficit, about the overall budget balance. So you need to impose further taxation on that, but by imposing further tax, the ability of those to pay is squeezing, and the economy is shrinking, and an abnormality in the income distribution is increasing. So the path would become narrower and narrower, and the solution would become elusive. So we need to work on that. We need to rethink the whole strategy, and we need to work on the holy cows within the sector. What are the holy cows? What are the holy cows on the expenditure side? What are those PSEs? What are those energy sector entities? What are the other areas where you have duplication of workforce and all that? And we need to do some kind of a cold surgery over there. Okay, the cold surgery over there may have an impact on maybe tens of thousands of people, but that tens of thousands of people would have positive impact of tens of millions of people. So we need to work on that. And then on the taxation, we need to work on the export and efficiency sector. For that, we need to pave the way for that by taxing those inefficient way. So I think that's narrow path is there. We need to cut down on the fiscal deficit. We need to cut down on your debt level, but we need to redesign those narrow paths to move towards a sustainable growth path once we have come out of it. I stop here.
Thank you. Thank you. You've touched upon many different issues, but if I may pick one, which is the extremely high inflation that we have in Pakistan right now. Headline inflation was at 35% for March. So Dr. Farooq Pasha, if I may turn to you for this question. So given the high inflation that we have in the country, what do you think is the optimal monetary fiscal policy mix that can be used to tame these high inflationary pressures?
Thanks, Arup, for the question. It's a very relevant question in the current circumstances. It's always, economists are always debating what is an appropriate fiscal and monetary policy mix in normal times. We are nowhere near normal times in Pakistan, and I would like to argue that globally also price pressures have not been that elevated for that long for a while. So we have to keep that in mind. A lot of points have already been covered by the earlier presentations and the panelists just now. So I just want to emphasize a few things. That in order to have any hope to bring this very high inflation down on a downward trend on a consistent basis, we need to have a coordinated response. Coordinated is the key word that I want to emphasize, that we cannot have a tightening monetary policy, or actually not really tight monetary policy, because real interest rates in Pakistan, even after 1,400 basis point hikes over the last 2.5 years, are still negative. So in order to address high inflation, you need to have a coordinated response between fiscal and monetary policy. If the idea is to contract aggregate demand, to slow economic activity, it has to be, number one, coordinated, that you can't be having an expansionary fiscal policy. You can't be given all the fiscal measures that we talk about. You can't be given untargeted subsidies. You can't be given exemptions on sales tax and various other taxes at the same time while you're trying to bring inflation down. So number one word that I want to emphasize is coordinated. And then the number two word I want to emphasize is consistent. So the policy mix between fiscal and monetary policy, while being coordinated, is very important. It needs to remain consistent. You cannot have periods of expansionary monetary policy followed by contractionary monetary policy, or expansionary fiscal policy, and so on and so forth. Unfortunately, what we have seen over the last few years in Pakistan is that both coordination and consistency has been missing. The other thing that we have to keep in mind as well is that fiscal policy and monetary policy operate with different lags. Monetary policy transmission historically, theoretically, takes a little bit of time. Depending on the country, it takes few months to few quarters. In Pakistan, there is a lot of research that it takes from 4 quarter to 6 quarter to have an impact. On the other hand, fiscal policy happens with a quicker lag. And we have seen that in case of Pakistan. We don't have to go back too far back. But even last year when we saw a global fuel price shock due to Ukraine-Russia war, while our domestic oil policies were going in the opposite direction, inflation from that started coming in a bit later on, and the central bank has been trying to respond to it. So it has to be kept in mind that the lag between monetary policy implementation and the transmission it takes, even in Pakistan, people ask whether there is a monetary policy transmission in Pakistan. If you look at the data, there are evidence where monetary policy tightening has actually led to slowdown in inflation, particularly core inflation. But that has tended to happen when it has happened in coordination with fiscal policy. Finally, the last thing I want to say before I stop is that this policy coordination is also important for a key factor that the central bank is focusing on, rightfully so, is inflation expectations. There's a lot of focus on anchoring inflation expectation, which is very difficult to do in current environment, where you just mentioned inflation is in the last 3 months have gone from 27% to 31% to 35%. Whenever I have interaction with our offshore clients, Pakistan is a medium inflation country, but it bears repeating that even for a country like Pakistan, 35% inflation is 4 to 5 times its normal average. Our average inflation over the last 30, 40 years have been 8 to 10%. So managing inflation expectation cannot be done only by central bank policy. It needs to be a coordinated effort. And in our economy, where there are administrative prices as well, they need to play an important role as well. So just to recap, in order to bring inflation down over a horizon of next couple of years, next few quarters, there needs to be a coordinated, consistent monetary and fiscal policy focused on price stability and anchoring inflation expectations.
Thank you. You have touched on some really key points. So the increasingly high inflation, slowdown in economic activity, rising unemployment, all of these issues have really impacted the poor and vulnerable households. But at the same time, the ongoing crisis required macroeconomic adjustment, for example, the adjustment in energy prices and fiscal consolidation as well. So Dr. Durnayab, under these circumstances, how can we manage this economic adjustment in a way that the burden falls more on those that can actually bear it? How do we manage this economic adjustment path?
I think we are just too obsessed with macroeconomic stabilization, and the IMF programs obviously don't help. As a start, I think we should stop looking at quick fixes, short-term goals. We've been doing this for 75 years. So for once, we start looking things in a bit of a longer perspective. Talking of the poor, there was a lot of talk about social protection. For us, somehow, social protection always goes in the distributive policies. BESP, give money. There is a food inflation, okay, give sacks of atta, and we've seen what's happening with that. Why don't we think about actually providing employment and opportunities to the poor? And I mean, story is for, sorry for plugging in some of the work that PIDE is doing. We have our whole reform agenda. We have our one-year growth strategy. I don't think these things would work in silos now. We have to take a broader picture, a complete picture. There was talk of investment. We talk of investment. How can, and it's always about FDI. I mean, when a Pakistani is not ready to invest in Pakistan, why and how would you expect foreign investment to come in Pakistan? I mean, you talk to businessmen. We've talked to a lot of chambers. I mean, there was a businessman who said that he was earning well, and I said, why don't you invest? He said that the policies change overnight. We don't know where our money would go. We have opened lockers in banks because we do need security, and it's none of the bank's concern whether we keep dirty socks or cash in those lockers. So the whole environment is not investment friendly. Real estate is the only place where we are putting in money. So I think all this talk about FDI sounds very hollow. Employment and opportunities, I think that's where we need to work on, and that cannot happen with the kind of the restrictive, suffocating environment we have here. We don't let businesses work. I don't have our sludge reports. PIDE is working on that. I mean, there is so much cost, financial cost, time cost for any business to run. Just imagine the kind of employment those businesses could generate. And I mean, whenever we talk of deregulation, somehow it's always considered to be a very pro-rich thing. It's not. It's not. Where does employment come from? So, I mean, and again, my apologies. This is a paper I did in 2006, demographic dividend or demographic threat in Pakistan. And as, I mean, you could have guessed, my hunch was that it's going to be a threat the way we are going. We are not investing right in our education, in our youth. They're angry, you can see it. The unemployment rates are high among the youth, and they are even higher among the educated youth. So, I mean, yes, physical dividend, balance of payment, all that is fine, but we have to put everything together. And somehow it's a 6-lettered word, reform, which we have made a 4-lettered word. Reform is where we need to go. And trust me, reform is the most pro-poor thing you can do. I don't think any poor would be against civil service reform. Any poor would be against freeing dead capital in cities, in regenerating our cities. So yes, cash transfers, BIS, and giving transfer in kind it's like you have a leaky pipe, and every time you just go and tie a piece of cloth on it. Yes, the leak would stop for a moment, but it would start dripping again. These are all very quick fixes. We need to take the broader picture, and wide-scale reforms are the way to go, even when we are talking about the poor. I mean, of course, the whole economy as well, but reform is the most pro-poor thing you can think of.
Thank you. I would like to keep this conversation going, but I thought we would also give a chance to our audience to ask some questions. So if there are any questions from the audience, we had this app slide on which you could post. So I'll ask my colleagues if there are any questions, if they could put that up on the screen. So Dr. Durnayab, there's a question for you. Pakistan's investment policy is quite liberal as compared to regional countries. Please pinpoint which investment laws are hindering foreign investors to invest, sorry.
I mean, that's why I said we have to take a holistic view. It's not just one policy acting in isolation. The whole unrest, the whole uncertainty. We are doing a survey, PIDE basic survey, in which we are looking at the beliefs, attitudes, and social capital among the Pakistanis, among each other, and with the institutions. Nobody trusts anyone. We don't trust our institutions. So it's not just the policy written on a piece of paper, it's how you perceive those policies, and how confident are you that the policy is not going to change.
Thank you. Any other question? Maybe we can take one more. Farooq Pasha, there's a question for you. As the ongoing crisis leads to a decline of incomes, how can policymakers protect poor and vulnerable households within a fiscally constrained environment?
So that's an excellent question, and I think some of the panelists have already talked about how we need to take a holistic approach in terms of, actually, if you think about it, the best thing you can do for poor other than reforms, and I agree with my panelists, inflation is a tax that is paid most by the poorest. So if you actually think about in terms of macroeconomic policymakers, what is in their hands, if you increase your ability to counter inflation, which currently it's not going in the direction that we want, one of the best thing you can do is to actually protect the purchasing power that people have. The income levels in Pakistan there've been a lot of inequality for a long time. But if you ask me that when we were having an inflation of 7% or 5%, was that being able to be a better outcome for even the poorest, or currently where the inflation has continued to rise to levels that we haven't seen in multiple decades, the best thing macro policy makers can do, and I would like to argue both from the fiscal side and monetary policy side, is to address inflation in a consistent manner and not, as she was saying, not as a stopgap measure. Our issue have been that even though we talk about doing reforms, our timeline and the view we look at them is in a very short period. We have various cycles. We have the political cycle, we have the business cycle, we have the global exogenous shocks that are not in our hands. So we need to take a broader perspective, and there needs to be a broad ownership, as it was mentioned in the presentation earlier. So it needs to be a combination of both macro and development policy with a longer term horizon to address in a sustainable manner issues being faced by the most vulnerable in our society.
Thank you. I think we have time for one more question. Maybe we can briefly talk about an issue, and we've also talked this about in our presentation, and it's in our report as well. And Ali, I'll turn to you for this question. So we have this issue of sovereign and financial sector nexus in Pakistan. The government has been increasingly relying on the domestic financial sector to finance the fiscal deficit. As of June, 70% of credit of the banking sector was to the sovereign. So in your view, what do you think are the necessary policy measures that can be taken to unwind the sovereign financial sector nexus?
That's a very good question. Let me get back to the stock of the debt as of the last year, fiscal year, when the stock of the debt was about 78% of GDP. Out of that, about 50% of the GDP was the domestic debt, and about 28% of the debt was the external debt. And the problem we have today is of the external debt repayment. And that's all the trigger the talk and on the negotiation of the debt restructuring on the external debt. But we've seen from the experience of the Sri Lanka and other areas that when you go and talk about the external debt restructuring, they talk about the domestic debt. And of course, they would say that your domestic debt is almost double of your external debt. So why not do that? We'll say that, okay, this is our local currency debt and all that. But they say that, fine, but that's the core of the problem. Your debt servicing, that majority of that is going to the domestic debt servicing. So you need to solve that. So yes, so when we go on the table, then we need to see that the financial sector, the domestic banks, that's Pakistan financial sector is primarily the commercial banks. There are no DFIs or other sort of institutions. Capital market, debt capital market is largely absent in Pakistan. And so when you talk about those, that domestic debt, and you said that 70% of that, the banking assets are of government papers. And someone showing the graph over there, the tier 1 sovereign to the tier 1 ratio, asset ratio, sovereign to the total asset ratio, Pakistan is abnormally high. So, and the private sector debt is much less than this. So when you talk about the restructuring domestic debt, essentially you're talking about you're challenging the deposits of the people. So the domestic debt is about somewhere about 34 trillion rupees, and your deposits are about 28 trillion rupees or something, if I'm not wrong. And your PIBs, which you're gonna restructure, is about 20 trillion rupees. So 20 trillion rupees, when you restructure those, and if you have a haircut of that on 20% of that, that's about 4 trillion rupees. And that 4 trillion rupees will go from your deposits. That'll cause a bank run. And when you have and they'll wipe out equity of the sum of the banks. So there's no consolidation of the banking system. They'll wipe out equity of the some banks. They'll wipe out the ability to pay the depositors and pay the liabilities, other liabilities by the bigger banks. And there's a bank run, there's be dollarization of the economy, and that could be a collapse of the financial system. So it's very, very important and very, very critical to deal with your domestic sovereign debt, and there your banking exposure is much high. And that's supposed to be a risk-free asset within a country. But that risk-free asset is become the risk. And that is imposing the risk on the private debt. And once you try to restructure that, the private debt would come and restructure that as well. That would be a lead to a total kind of a collapse to the banking system. So we need to see very carefully, because Pakistan is a kind of a unique case. Its debt to GDP is 80%. That's not that very high. But banking sector exposure to the sovereign is very high. So that is the unique point. So that's why I go back to the first point of the solving the fiscal puzzle. That's so important, because if you don't solve that fiscal puzzle, that will not only translate into the inflation tax, which other people have talked about, but that will seriously challenge or hamper your savings in PKR. Either these are in the bank deposits, either these are in the insurance companies, either these are in the pension funds and all that. So that will seriously jeopardize the savings of the people. And that once you go that route, it'll take 7 to 10 years at least to recover. So that is a very critical point. We need to realize that, because in the next 4 months, where I see the debt restructuring talk would start, and that would come to the domestic debt restructuring, and then the people would realize what kind of an animal we are talking about and what kind of a panic this can create. So we need to sit down today and work on that narrow path religiously, and here that's the political uncertainty, because that's leading to that debt restructuring and the absence of the IMF and all. So we need to have those political actors, we need to have those institutional actors, be judiciary, establishment, PTI, PDM, all to sit together and work for the 220 million people of this country, the deposit holder of this country, the inflation tax paying people of the country. That's very important. Here I stop with this food of thought that this financial sector risk is very high with the domestic debt restructuring, and that can lead to a domestic banking sector collapse. Thank you.
Thank you very much. Well, we'd like to go on, but I think we're on time, so we should conclude here. Thank you to all our panelists for joining us. It has been a very engaging conversation. Thank you for the insights that you shared. Just before we close, Mr. Khurram Dastagir is here, so I would like him to come on stage, and if he has a few words to share. Thank you. And after that, we can then start.
A'udhu billahi minash shaitanir rajeem. Bismillahir rahmanir rahim. Let's begin by thanking our hosts, the World Bank and Pakistan Institute of Development Economics, who are both doing excellent work in helping us in trying to reach that holy grail, which is evidence-based policy making. So we keep at it. We try to obtain data, but as we have seen in the last year or so, that a conjunction of different events have created what you can see a perfect storm of difficulty for Pakistan, beginning with the manifold rise in energy prices because of the Ukraine conflict, and followed by, in September, which most of us tend to forget, but ladies and gentlemen, we had a devastating flood last year in September and October, and whose effects are still with us. There are still our brothers and sisters in Sindh who are without a roof over their heads. There are still people who need to gain control of their livelihoods again, which were destroyed by the flood. And then, of course, the supply shock created by the flood has given us this very difficult inflation challenge that we currently face. But there are, of course, multiple challenges with which we continue to have a dialogue, both with the World Bank and PIDE. So I just want you to give a big hand to both these institutions for helping us in trying to reach better policy making, which is never easy. It takes effort and occasionally courage to take difficult decisions, and to be able to reap the rewards of those difficult decisions is another challenge. But we are engaged with both these institutions in a very valuable knowledge partnership. I came here just to listen and learn. I didn't know I had to speak to get my iftar, but that's my acknowledgement that these two institutions, one international, one are very much homegrown institution, both are doing outstanding work. We are, of course, used to acknowledging the World Bank, but I do want to say that in Nadeem ul-Haq's leadership, PIDE has also grown tremendously in the last few years, and its research, not only its research output, but I want to congratulate Mr. Nadeem ul-Haq for the integrity of the research also. That's extremely important, that whatever research is done is based upon data that is reliable and that could be used in better policy making. So with, again, my appreciation to both the World Bank and PIDE, I wish you a good iftar and good evening. Pakistan Paindabad.
So I think with that, we can close the event, and thank you once again for joining us.